kind of our thesis coming in months ago, even before the launch of Stretch, was there's going to be a lot of preferred stock issued by DATs. And then that thesis kind of evolved as Stretch took off.
Is it more treated from the perspective of a high-yielding bond, and are they planning to then later sell their holdings to another buyer?
It's long duration, it's not secured, there's no liquidation price, and if you compare these DATs that have levered up and are prepared for a bear market, then you don't have the volatility decay that you might have in like a levered ETF.
Can you walk us through the determination of how the points multipliers are calculated for both APYX and APY-USD?
If you have a basket, then maybe you get lower volatility, and certainly you can get higher yield because the other DATs are going to be willing to pay more than strategy is willing to pay.
GM, and welcome back to episode 87 of the Odyssey Pod. We are joined again by our recurring guest, Joseph. We already had you on, I think it was episode 50. It was sometime in the fall last year when we talked about DFDV. So for those who don't know you yet or who haven't watched that episode, can you give us a brief intro to your background and how you found your way to now APYX?
Sure. Hey, Max. Good to see you again. I currently am a founding contributor for APYX, APYX. I'm also the chairman and CEO at DeFi Development Corp, DFDV, which is the first US-listed Solana digital asset treasury company, the first US-listed non-Bitcoin digital asset treasury company. And I've been working in the crypto space since 2013 when I went to work at CA Vertex, the first Bitcoin exchange in Canada. They made me the CEO there, and I sold that company to Coinsetter, which got acquired by Kraken later. I worked at Coinsetter for a bit, then worked in it's like a market making OTC kind of business for crypto that I'd started. And then I went to work at Kraken in 2016, and I was at Kraken for about 8.5 years, most recently as the chief strategy officer there, and I left in mid-24. I went back into market making on mostly centralized exchanges, but we also did a Pendle limit order strategy. And then early in 25, I started working on DeFi Development Corp with the rest of the team there to do our change control with the NASDAQ listed company, which was Jan Over, and it pivoted to DeFi Development Corp, like I mentioned earlier, Solana Treasury Company. And then we started trying to raise a preferred stock. Was kind of the topic at hand here. Back in, I think we first started in August, and we went to market with it September or October, but we struggled raising the pref, and we were watching Sailor and Strategy, of course, and Stretch had come out in July, and we thought that was a really interesting instrument, but I think we didn't kind of grasp it until maybe, it was November, when we were talking amongst ourselves at DFDV, and we said, this is probably the future of how DATs are going to fundraise, and to, what's the word? I guess start the flywheel. And I think we've seen this kind of play out as Stretch has grown in the past couple of months. But back in November or early December, we said, this asset would be a fantastic backing or collateral asset for a stable coin, because of these DATs with large treasuries like MicroStrategy or Strategy, and now also Strive, which has issued SATA, another variable rate perpetual preferred. We thought that they would be able to pull almost all the volatility out of the preferred price and run it all into the interest rate, or largely into the interest rate or dividend. And that sounded like a great collateral or backing asset for a stable. So off we went on working on that.
How did the idea originally emerge to build this on top of MicroStrategy and STRC instead of on top of DFDV or any other DAT?
Yeah. Well, we were really paying a lot of attention to Sailor. So he had done a couple of presentations that we'd seen in person. And I guess my perception or perspective has been almost since we started working on the DAT, right at a year ago now since we launched, that preferred would be a path for fundraising for DATs, because the way the preferreds work, it's not just a stretch with a variable rate perpetual preferred, but you can issue a preferred on basically any financial instrument, and then as a public company, one can issue a preferred that can track of just about any financial asset that you could imagine. So you could wrap like a DeFi vault in a preferred instrument and pass it through to users to trade on Nasdaq, in their Robinhood account or whatever. And that was really interesting to me. And I thought that since Strategy had pioneered with a number of these crypto-backed instruments, that there would be kind of I don't know, there would be a bunch of them essentially. And I thought that there would actually be business models where DATs issued mini prefs. Like, oh, I want to tokenize like 10 different, or not tokenize, I want to equitize 10 different vaults and make them available for trading on NASDAQ, for example. And the cost of doing that is actually pretty low. You might be able to get a pref out for, I don't know, $500,000 if there were buyers for it. So it's really not extremely expensive in kind of the context of DATs to issue these. So kind of our thesis coming in months ago, even before the launch of Stretch, was there's going to be a lot of preferred stock issued by DATs. And then that thesis kind of evolved as Stretch took off and as SATA launched, which is Strive's variable rate perpetual preferred, which is very similar to MicroStrategies or strategies. So anyway, kind of with that thesis in mind, there's going to be many prefs to, well, there's this kind of nexus around this variable rate perpetual pref, and the balance sheet of these companies is very large relative to the total size of the pref, and that this might be able to get the flywheel going for DATs again to continue to fundraise, to trade at a premium to their net asset value, to be able to issue common like we're seeing Strategy do now coming off the Stretch raises. Then we said, okay, we think there's going to be a lot of these. There's probably going to be 10 or 15 DATs that issue variable rate perpetual preferreds, and they'll be across multiple assets. I expect the Ethereum DATs to do it, at least one Solana DAT's going to do it, so on. So we said, well, it probably makes sense for there to be a basket of these assets backing a stable coin, because if you have a basket, then maybe you get lower volatility, and certainly you can get higher yield because the other DATs are going to be willing to pay more than Strategy is willing to pay.
Can you walk us through the mechanisms behind STRC? I'm pretty sure that most of the audience has heard about the basic mechanism of how MicroStrategies and DATs are working in general, but what is setting STRC apart? How do the different rights and preferences work? How does the yield come to be, and how does it ultimately fuel base yield of all the APYX products?
So I don't know if this exactly answers your question, but it gets close. I did kind of jump ahead on, and I'm pretty deep in the terms of these preferreds, so excuse me, but overview on Stretch. So maybe first off, overview on preferred stock. So public company listed in the US, but also probably listed in a number of other geographies, can issue different classes of shares. And one of the terms for the classes of shares is preferred stock. And like I mentioned earlier, a preferred stock it's like just a legal and financial contract. So your lawyers would write up, this is the financial terms that we're going to offer on this preferred, and then it can go to market, usually via an investment bank, for an IPO to get listed on the exchange and have some amount of market cap or whatever behind it, right? Like you might be able to issue a pref with a $20 million market cap, or you could issue a pref with a $1 billion market cap. And then the idea with the strategy related preferreds is they have an ATM kind of on top of these preferreds. They're able to issue more of the preferreds and sell them into the market. And when the company does that primary issuance and sells into the market, via the ATM on the pref, then the company actually gets that money and can use the money to do other stuff like buy Bitcoin. So as a quick overview on preferreds generally, it's just a financial contract that a public company can kind of issue, and it becomes available to public market investors after SEC review process. But the barrier to getting these out there is not insurmountable. So now on Stretch specifically, it's issued by Strategy, ticker's STRC. It's a variable rate perpetual preferred stock. So it's a preferred stock that we already discussed. It's perpetual means it doesn't have an expiry date. So it's some investors are thinking of it as like debt, like a long-term debt you never have to pay back. And it's variable rate. So variable rate means, of course, that the interest rate or the dividend on Stretch can vary. They pay dividends monthly, and they have a par value. So the target value for Stretch is $100. So I think when it was issued, it was initially IPO'd at, I want to say 90, but you kind of see other prices for initial issuance. One of the things that an investor could do is participate in the IPO for the variable rate perpetual preferreds that I think the other DATs are going to issue. They might issue at 80, they might issue at 90, but they have a target price of 100. And the idea is that if the DAT's successful, the pref trades up to 100, and then they run the ATM on the pref at 100 to raise further capital.
So you just mentioned that the company issuing these instruments is often viewing preferred stock as like debt you don't have to pay back. So from an investor's perspective, do they basically, if they buy it for $100 a share, do they write these $100 to zero and basically have, in this case, a 9 or 10 year plus time horizon, so the 11.5% annually, or however the variability of that rate is going to change, it will finally outpace their initial investment at some point in time? Or is it more treated from the perspective of a high yielding bond, and are they planning to then later sell their holdings to another buyer?
Yeah, thank you. Yeah, it's probably fair to refer to it as a bond. But yeah, the idea is that if the company is successful and the preferred trades the way it's kind of supposed to in the long term, that it would maintain its value around 100. It would trade up to 100. It would stay around 100. The dividend would vary to target the $100 price. So an investor would buy, presumably around 100, earn the dividend for however long they held the preferred stock, and then also be able to sell it for presumably or hopefully $100 or around $100.
So
Now,
the bet is that you're both optimistic on the company generating cash flows to service the yields, but you're also taking a directional bet on the company itself, because at the end it's preferred stock and it's not debt. So you are exposed to the equity of the company, right?
it depends on, well, yes, but it also depends on the kind of capital stack of the company. So, and I think I have a slide on this, but yeah, I have some mention of it here. So, the capital stack for Strategy has MSTR, the common, at the bottom. It's like the base of the pyramid, and then there's the junior preferreds. I think Strike and Stride, which sit on top of the common, and then I believe it's Stretch next, and then there's Debt and Strife. I guess Debt, Strife, Stretch, Strike, Stride, MicroStrategy, or MSTR stock is the stack. I should probably have a slide for that. I think I might. I do. So I think this is like a risk area, and Strategy recognizes that this is a risk area where there are assets in the stack or debt. It's not an asset that's senior to Stretch. So in a default or like liquidation scenario, the debt holders would get paid back first, and then strife holders, stretch holders, etc., until commons last in line. Now, if you compare this to Strive's capital stack is simpler. It's close to stretch only, and then common. And so I think they wiped out all of their debt when they had a recent transaction related to SATA. That I think is the cleaner approach, and I suspect that we'll see strategy move in that direction in the longer term. All of strategy's debt is convertible debt, and it will expire. I think by 2029, I want to say is the last one, but we can just go look on the strategy website. But I think by then, by the time we're approaching expiry, it'll all be in the money because it'll convert to common. Then, because it's pretty close to conversion price on, or above conversion price on most of the debt already. And then the other is that I think stretch will be much larger than strategy's debt. So, in other words, this is definitely a concern area, but it should improve over time for strategy. And I think the other kind of younger DATs that have different looking capital structures have learned from strategy, like we've seen Strive, and they'll probably just issue the variable rate perpetual preferred and have it sit on top of the capital stack because they won't have debt that's senior to it.
What is the unique value proposition of building APYX on top of STRC instead of just bringing a tokenized version of it on-chain that people can trade in and out of?
Yeah, well, we thought pretty hard about this. So I think there's a few benefits. So we use a two-token model like Athena, like a USDE and SUSDE, where we have, I think I have a slide for this too. Like I said, there's two-token model. APYX USD is the non-yield bearing stable. APY USD is the yield-bearing stable. And the idea here is, and I think the audience is probably familiar with this kind of mechanism already, but a project can earn yield on all of their backing assets for their non-yield bearing asset. And the yield bearing asset can be denominated in the non-yield bearing asset. So APY USD's accounting asset is APX USD, and APY USD is a vault that is up only in terms of APEX USD. And so the only way to get APY USD, you can buy it, but all of it comes from ultimately locking APX USD and receiving APY USD, which has an unlocked duration, the 30-day cooldown. And I'll get into why there's a 30-day cooldown in a minute. Imagine that there's like outstanding value of APEX USD of $2 and outstanding value of APY USD of $1. In that case, all of the yield that's generated on the $2 could be, or almost all the yield could be passed into APY USD. So the two-token model facilitates channeling of the yield of the underlying assets to just the holders of the duration-based asset, which is what we see with Athena as well, where USDE earns no yield, but SUSDE can earn more yield than a user might earn running a funding rate trade on their own, theoretically anyway. This is one of the advantages of issuing a stable or a token on top of Stretch. Now, the other advantage, I think, is using a multiple preferreds as backing. So if we're on the APYX dashboard here, we can see the holdings. So currently the treasury is 75% in Stretch, but it's also 8.5% in SATA, which I mentioned before is Strive's variable rate perpetual preferred. And what this allows or facilitates, we think, is there's some diversification. And in the longer term, we think there's going to be a bunch of these assets. So, Bitminer might issue one, et cetera, right? And we expect that the yield on those assets will be higher than Stretch, because Stretch is going to be like, it's the most liquid, it's issued by the largest balance sheet DAT. So the cost of capital at minimum for the other DATs is going to be higher. Also, the other DATs, depending on their asset, if it's a proof of stake asset, they probably earn yield on those assets, and they might be able to afford or justify to the market that that's okay for them to pay a higher yield. So we think that we get some diversification and some additional yield generation from holding a basket, which is another reason to have a stablecoin product sit on top of Stretch itself. So probably like the TLDR is higher yield, lower vol. Lower vol can come from being over collateralized and potentially hedging out some of the risk. We've done extensive modeling on the hedging. We're not hedging right now, but there's been extensive modeling on it, and we'll share with the community if we do start to hedge, but that should be the advantage, higher yield, lower vol.
So do you view yourself almost as a DAT on top of other DATs? And how do you make the allocation decisions into like various sources of collateral?
Well, we might have different definitions of DATs. So, no, I don't think of us as a DAT on top of a DAT. I guess I hadn't thought too much about that angle. But I think that a DAT's purpose is leveraged exposure to the underlying asset. I don't, like APYX is not expected to lever up. That's not part of the model. And then, I don't remember what your other piece was.
Yeah, how do you decide to allocate into one or the other preferred instrument?
Yeah. Uh, well, if the instrument fits I guess we've laid out criteria for this, but I haven't shared it anywhere, so I'm a little hesitant to overshare. But the idea is that if it looks like Stretch and, we're familiar with the business already, know the company, the balance sheet is, I guess, adequately safe, then APYX could potentially allocate to it. But right now, there's only two assets that fit this criteria, and that's Stretch and SATA. We just expect that there'll be more in the future. And of course, we talked to a lot of the DAT management teams about their future issuance of these assets, and would be excited to participate in the IPOs of these assets if the criteria were met. But it basically has to look like Stretch and
Yeah, I mean, we
similar
don't have to go
collateralization
too
and
deep
so on.
into that section. Maybe can you walk us through how the end-to-end money flow works? So if I buy APY USD or APX USD, how does it end up getting allocated and how does the yield end up getting distributed to me? And maybe related to that, how does the 30-day cooldown fit into this?
Yeah, here I have another slide. Okay, so there's a few challenges that we have here, so I'll just kind of try to lay them out maybe before we start. So as a yield farmer, my expectation is that my yield streams in smoothly at every block. The dividends are paid though monthly from the two prefs that are out so far. At least they have different record dates and different dividend dates, so maybe there's some smoothing that takes place from that. But we get the dividend once a month. And so the way the contract works is for APY USD, there's well, before I get into that, let me just run through the slide then. So we receive our dividends, we convert the dividends into APYX USD, and we put them into our yield distributor contract. There's a linear vest that streams over 30 days. So the idea is we receive the dividend first, convert it to APYX USD, stream it out to APY USD holders over the period, which runs up the value of APY USD relative to APX USD. The kind of problem with this is, well, one of the problems that we're having right now with this is that when TVL is increasing rapidly, the rate for APY USD goes down because there's a specific amount of assets in the vesting contract. Like, let's say we put $100 in the vesting contract and there's $1,000 of assets that are receiving the yield. Oh, great, they're getting 10% yield in my example. But then suddenly there's $2,000 of assets in the receiving the yield. It gets split across everybody. Now everybody's getting 5% yield. We thought this was a feature when or before we launched. Like, okay, now there's kind of a smoothing of the entry into APY USD, because as more users come in, the rate comes down until the next dividend date. And then vice versa, if there's significant withdrawals from APY USD, the rate goes up. So users who stay in are rewarded, and maybe we get kind of a smoother increase or decrease in APY USD TVL. But this has been problematic, I would say, for launch, because we say, oh, the headline yield is 12% or whatever it is, and then it's decreasing. I think at one point it came down to like 5.5% because the TVL had grown. So we've topped it up at least once. Basically ate it, paid for the top up with the some of the money that we'd raised. Anyway, that's how it works, and some of the problems that we've had. The reason the 30-day unlock exists for APY USD, which I understand is quite long, is we're worried about the ability for investors to exploit the like arbitrage between the linear yielding over the 30 days and the dividend on stretch. So if you had a shorter period, and especially with access to tokenized stretch, which exists, Xdocs with Kraken has issued a tokenized stretch that passes through the dividend. We think that there's an arbitrage opportunity there where a user could earn, net 20% annual yield just switching between APY USD and stretch, depending on dividend dates. Hence the long unlock period, and during the unlock period, users don't earn yield. So that completely eliminates that vector, but of course it adds friction.
Yeah, so I think most people who have studied and gotten like a business or finance degree are familiar with that post-dividend effect that you have with many equities. So this is basically targeted to eliminate it at the cost of introducing more friction and that like lag of redemption, because otherwise, since you're a vehicle built on top of another, it could be gamed in a way, right?
Yep, that's right. Now, we might be able to change this later but if stretch is the dominant instrument and it continues to dividend monthly, and it's like 80% of the balance sheet or treasury, then I think it's very hard to, make a change here. If the basket is well diversified, like let's say there's a Bitminer pref and it's incredibly successful, it's rivaling strategy, it's as liquid as strategies or as stretch, then they would probably have a different dividend date. And then I think maybe the problem's reduced.
Speaking of the yield distribution and earning yield with APYX and the two products, you have two pendle markets live, which are sitting at roughly 28, 29 million in TVL right now, I think, both for APY-USD and APX-USD. So do we want to walk through these and explain to the audience how they are earning yield? And also, that will be a good connection to talking about your points or pips program that is going on right now.
This is our Pendle markets. I just searched APX on Pendle, brings up the two markets. As Max mentioned, there's a APY-USD market and an APX-USD market. The APY-USD one is the currently more liquid one with the currently higher yield, though we did, and we're running a points or pips program right now. We're calling it their naming convention is pips for the program, and we've got a much bigger multiplier on LPing and YT on APX USD than we do on APY USD. But yeah, let's see. For a minute we were like the headline product on Pendle right after we launched with highest LP numbers, highest RWA, highest stable yield, which was fun for a minute, and a life dream achieved there, I would say, as a big Pendle fan. If I click into the APY USD market, I guess if you're watching this, you're probably pretty familiar with Pendle. But there's at least some liquidity here that exciting in my opinion.
Are you also, on that note, benefiting by the recently launched limit order incentives by Pendle? And in case, that's only a short topic to cover, can you walk us through the determination of how the points multipliers are calculated for both APX and APY USD? And how you're steering them to incentivize TVL growth in one or the other?
Yeah, we do have the limit order incentives on APY USD market, and you can see with the icon here, and the rate's quite high. This is based on the relative small number of limit orders placed on APY USD right now, and of course, if there was a much larger order, then the yield would be lower. But that was nice of Pendle to add us to the program there. when they announced it, we were like, oh man, what do we have to do to get on this list? Let me go over to the points program here. So we have a rewards page at app.apyx.fi/rewards that lists all of the pips multipliers, and we also have, let me just grab this. We have a blog post on the points program that is very detailed, which includes, here, let me just grab this here, which includes the total supply that we're going to drop. Season 1's ending in, I guess it's 9 or 10 weeks now. Until we're ending, there will be a governance token, APYX. 5% of the total supply will be airdropped to participants in the points program. I get questions about, like, does this include or not include whatever? Like, it's just a clean 5% to airdrop participants. There's nothing else going on here, and could be modeled. And then if we go to, I think this is potentially just a little out of date, so I'll go over to the rewards page now because I think we might have added a market or two. We've got all the ways to earn points. I'll just highlight a couple. YT on APX USD is the highest yielding at 32x multiplier, and then the lowest yielding is 1x at just holding APYUSD. Of course, if you hold APYUSD, you just earn the base yield on APYUSD. And if you're holding APX USD, you're not earning the underlying yield, but we've juiced the points multiplier as a hopeful method to compensate. And we've just recently listed our first morpho markets. So right now it's just a APY a market on a morpho with Alpha Ping as the first curator. We're right around the corner from launching our USDC markets, and the PT markets are actually up already. They're just not in a curated vault yet, but they will be soon. And then we have some incentive on on 2 pairs on Curve, but to get the reward, you have to commit your LP tokens into our commit contract.
I think this is a quite concise overview of all the different yield opportunities on top of your products. Related to the APYX tokens, what will their utility be, and why would anybody want to farm your points program beyond just getting the yield on APYUSD?
Yeah. So this blog post goes into quite a bit of detail on the future tokenomics of APYX, and our plan is to launch with a fee switch on. So we haven't completed the design on the APYX token, but much of the details are laid out in this blog post. So like I said before, 5% of total supply is going to get airdropped to the points farmers or the pips farmers, and you can model out. I mean, there's quite a lot of detail in this blog post on the token distribution, the vesting periods for each of the buckets, and then down here we have the revenue switch for APYX stakers. So there'll be an ability to stake or lock APYX, the governance token, to earn some percentage of the additional revenue generated by the project that is not flowing through to APYUSD holders. So I encourage, if you want a model, there's definitely enough information out to build a model on how to value the token just on a revenue basis with assumed TVL numbers or even current TVL numbers. And I'm excited about this because the idea is, well, if you read the blog post, you'll see, but the idea is that there'll be, I'd say, fairly strong incentives to not sell APYX for airdrop recipients and for team, foundation, etc. Because if the project works, it ought to be like long-term accretive to hold the governance token. I don't know. That sounds risky to say out loud, but assuming that the stuff works out, then I'm excited about the revenue stream from the governance token.
I think you gave very sound explanations for all the mechanisms behind APYX. To zoom out a little bit, what is your current view on the state of DATs? I would say that the consensus on many market-focused podcasts on crypto Twitter and like a lot of the common sources that people consume is that DATs are kind of a thing of the past, of the 2025 market era, and that they are not really interesting anymore, and that they are rather baggage right now to the market than a benefit. I think the only time that has changed is particularly with the launch of STRC, because there has been a lot of acknowledgement that the volume that Sailor has been able to issue with STRC contributed a lot to the recent recovery rally that we've seen on BTC. So what is your view on DATs right now, since you are kind of forced to be opinionated about the asset price of the underlying as well, of course? So you are forced to be opinionated about the state of markets and market cycles, and also the resilience of the equity and debt structures of these instruments.
Yeah. Thank you. Okay, so there's like 200 DATs now, and I think many of them, how do I put this? So I mentioned before the purpose of a DAT is leverage exposure to the underlying asset. There are many DATs with no leverage, and the DATs with no leverage ought to trade like an ETF or worse than an ETF, because their expenses should be higher than an ETF. And even if they're staking the assets, if let's say you get the idea, like they're going to pass through like 1 or 2% or 0% yield after staking if they have costs, and these companies have costs that are in many cases higher than an ETF, because these companies haven't achieved enough scale to have economies of scale to have the cost come down on a per asset or per unit of asset basis. So I think, however, there is almost no incentive for these companies to kind of go away, because the management teams or the boards or whatever can essentially sit there forever, earning their staking yield, selling off their staking yield, paying themselves, and essentially not doing anything, waiting for the bull market. So I think a bunch of DATs are probably just going to become irrelevant, or have already become irrelevant, fall by the wayside. Nobody's going to talk about them. Their stock's going to trade below 1x MNAV. I think the interesting DATs are the ones that are able to lever up. And levering up sounds risky, but for a DAT, because it's a US listed public company, or I guess in some cases foreign listed public companies, they have access to ability to raise capital in ways that almost no one else has access to. So I should have made a slide on this, because it's a little bit complicated, but if you think about like the range of ways that you can get leveraged exposure on crypto assets, like let's say maybe like a spot account that has access to margin might be like, one way to do it, or perpetual swaps, with what's the word? Anyway, you have risk of liquidation in both of these cases, and the interest rate on perps is variable and can go extremely high in particular situations. And if you kind of think about that as on one extreme, like that's what's available to kind of retail users or small prop shops, say, on one end, as the most risky way to get leverage in the crypto space, to and you walk through like what the other possibilities are, like I got an unsecured line of credit from a bank to be able to trade crypto or something. Like maybe that's like less risky, because then it's not price related for your liquidation or your margin call, and you walk on out on like the opposite end of the risk spectrum, and at the opposite end is these variable rate perpetual preferred stocks. And kind of in between are a bunch of other ways that we've seen DATs raise money or get leverage. So one of them is convertible debt. The convertible debt, in many cases, you have to look at the detailed terms of the debt, but in many cases, the debt is not secured. So it doesn't matter what the price of the asset is, the underlying asset. I mean, it could go down 90% and the loan can't get called. This is how strategies are structured and how DFDVs are structured. And as long as you think the underlying asset's going to be up over the total lifetime of the loan, and these durations are getting longer on some of the more recent deals, 4 years, 5 years, 6 years we're seeing now for the convertible debt, then what kind of comes out of this is the DATs have access to what I've referred to as safe leverage. And it's long duration, it's not secured, there's no liquidation price. And if you compare these DATs that have levered up and are prepared for a bear market, then you don't have the volatility decay that you might have in like a levered ETF. So if you're trading like a 2x levered ETF, these ETFs are rebalancing. At the bottom, they have to rebalance. At the top, they have to rebalance. And you're kind of getting like shaken out along the way. The DATs should be able to like diamond hands hold at the bottom and maintain their leverage without liquidation. And then when the market turns, we should see this massive upside for those leveraged DATs that didn't or couldn't get shaken out at the bottom. So I think that's kind of the narrative now and the differentiation for these DATs. So Strategy's got leverage. Strategy's not going to get shaken out at the bottom. Strive's got leverage. Strive's probably not going to get shaken out at the bottom. And the ones with no leverage are boring and underperforming ETFs.
Yeah, I think that's a rather compelling case for the long-lastingness of DAT as a whole. I think the fears, especially that we have seen in January and February before the whole STRC revival started with MicroStrategy about DATs collapsing and adding huge sell pressure, it was a little bit overblown. I mean, there's certainly the risk of getting blown up in the mid to long run with these structures if you take a bet that is completely off. But I would say the longer tail DATs who are dabbling in more, let's say, exotic assets also have much lower size. So I would say the expected negative impact, if in case they blow up, for the overall market is rather muted. I mean, of course, there is like the overhang risk, and it's not like a Damocles sword that will kill you if it falls down. I would say it's another downwards pressure factor, but like if it becomes so crucial that it kind of kills or significantly hurts the industry, I would assume that for that to happen, we would have to create much larger industry internal problems beforehand. And I think in that case, DATs are rather a symptom of that than the cause of it at the get go. So yeah, maybe before we are hitting the end of the show, what will happen if you are becoming the largest holder and allocator into STRC?
Yeah, we post a lot about becoming the largest stretch holder. What will happen? Well, I guess Bitcoin will be way up, and well, the governance token would be worth a lot. I guess would be the two things that would happen if that were the case. The idea of it makes me a bit nervous because Stretch has to grow in liquidity proportionate with APYX's future growth. You probably don't want to be in a situation where the projects or products built on top of Stretch are like thousands of percent of daily volume of Stretch, because when there's a drawdown, the products built on top need access to liquidity to be able to get out.
Yeah, I think that goes in a very similar direction to the criticism of MicroStrategy and Sailor, which is that whole like Eggman parable thing. I don't know if it's that common in English as well, but in German, it's basically like if you have a competing market of different sellers of eggs, and one guy buys up all the eggs to like dump the price, and then like he can't really buy or sell them at that price anymore because he's holding all of them. And that is a very common allegation against Sailor and the whole like MicroStrategy DAT structure, since they have already reached a size where they hold such a significant portion of like all the liquidly available BTC. I think it's 5% or 6% that they're holding right now. I'm not too sure about it, but it's in the hundreds of thousands. So you're basically forced to hold them for forever. So if there indeed is a very extended bear market that is surpassing all the previous bear markets in downwards price action, and really everybody loses interest in the asset, and there's no upwards price action to be expected, which of course all of us involved in this industry are not necessarily betting on, then it indeed could be like the last nice stab that would kill the asset, because you'd have to unload such masses of it. And if there's no marginal believer into the upside of BTC, then it could indeed die. But I guess that is not what all of us are betting on. So what is your outlook for the rest of the year and beyond, and any last takes that you would like to share?
Yeah, outlook for the rest of the year. Honestly, I have a lot of uncertainty on the macro side. I do expect Stretch to just continue to grow though, and I think the uncertainty on the macro is probably fine or good for Stretch and Strategy because they get to continue to buy relatively cheap Bitcoin, as long as the money continues to roll into Stretch. And I expect that Stretch will, for the most part, or maintain stability and build a track record of more stability than it has, lower vol in the next 9 months. And yeah, I expect certainly hundreds of millions and maybe billions in TVL in APYX over the 9 month period.
Very nice. I really enjoyed our episode. Thanks a ton for coming on. I always like it how you're able to explain these concepts of financial engineering in terms that everybody who has a basic understanding of markets, of finance and equity markets can follow. So thanks for coming on. Where can people find you? How can they reach out and follow you and APYX?
Yeah, well, the website is apyx.fi, apex.fi, and we link to our Discord there. The primary community is in Discord, so you're welcome to come hang out with us. I'm X in Liberty on the Discord, and that's my Twitter too. I have to go look at exactly what my handle is. Yeah, 0x in Liberty on Twitter as well. I'm not very popular on Twitter. Happy to hang out on Discord.
We'll make sure to put all the links in the description. Thanks a ton for coming on, and I hope we'll have you on the podcast again very soon when APYX is the largest STRC holder and has significantly changed the state of DATs and the capital allocation there.
Yeah, hope so. Thanks, Max, for having me, and good to see you again.
Have a good one, Joseph.